Hi all, this is Sameer Sawant, a research analyst from Mira Asset Sharekha. RBI has just announced its February 2026 monetary policy. In this video, I'll quickly cover what RBI did, what they are saying about growth and inflation, and most importantly, our view on this MPC meeting. The RBI has kept a repo rate unchanged at 5.25%, so SGF stays at 5% and MSF rate stays at 5.5%. The policy stance continues to be neutral. In simple terms, the RBI believes that current interest rates are comfortable and do not need any immediate change. The RBI has turned slightly more positive on growth front. FY26 GDP growth has been raised to 7.4% from 7.3% earlier. Private consumption and investment remain strong. Rural demand is improving, helped by steady agricultural activity. On the supply side, services are doing well and manufacturing is seeing a revival. The RBI has also upgraded growth estimates for early FY27, showing confidence that growth momentum will continue. Overall, the message is clear: India's growth story remains intact and stable. Inflation was very low towards the end of 2025, but RBI expects inflation to move up gradually from here. FY26 inflation is projected at 2.1%, which is still very comfortable. Inflation may rise in coming months mainly due to base effect. A small upward revision is due to higher prices of precious metals. The important key takeaway: core inflation remains benign at 2.6%, which gives RBI comfort to stay patient. The RBI says liquidity in the system is still in surplus. Past rate cuts have been largely transmitted, with lending rates coming down meaningfully. Even though gross borrowing looks higher for FY27, the RBI believes net borrowing is well contained. The central bank is confident that it can manage liquidity using tools like OMO and variable repo operations. India's external position also remains strong, with healthy reserves and manageable current account deficit. Some important developmental steps announced today are as follows. Collateral-free MSME loan limit has been increased to 20 lakh from 10 lakh earlier. Bank will be allowed to lend to REITs under safeguards. Strong consumer protection rules, including compensation for small value frauds. Regulatory easing for smaller NBFCs, improving ease of doing business. Our view is that the policy is largely neutral for banks and NBFCs. The RBI has not announced fresh liquidity measures like OMO because it wants to ensure full transmission of earlier rate cuts. However, its clear assurance on actively managing liquidity is comforting. The increase in collateral-free MSME loan limits opens up new lending opportunities for banks. Allowing the banks to lend to REITs is also a positive for the real estate sector, as it can lead to more stable and potentially cheaper funding. Overall, the RBI is signaling growth, comfort on inflation, and readiness to act if liquidity tightens. To sum it up, this was steady and balanced policy focused on maintaining growth momentum while keeping inflation in check. We'll continue to track on how this measure play out. Thanks for watching.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.